All right. This next group starts with this Falcon Company sells widgets. This group, I think, is mostly budgeting things. And this one is about as, this particular problem here, this first one is about as complex as any you're going to see. Um, we've got approximately 10% of the sales are in cash, the rest are credit sales. Collections follow a pattern of 30% collected in the month of sale, 40% collected the month following sale, and 25% collected 2 months following sale. 5% are never collected. For the sales collected in the month of sale, 90% receive a 2% discount for early payment. So, I'm going to go with the first thing is there's a little ambiguity in this question in that the approximately 10% of sales are cash. That part is clear, but then the collections, 30% of the month of sale in cash, but then they say 90% receive a 2% discount. So this second sentence down here in the narrative that starts with collections follow pattern, I'm going to assume they're talking about credit collections only with that. Otherwise, the 90% receiving a 2% discount for early payment doesn't make a whole lot of sense to me. Okay, so we want October, November, and December. And there's several ways you can do this, but I'm just going to do the cash sales up front at the beginning. So cash sales, October was 120,000, so that would be 12,000. November was 95,000, so 9,500, and December was 85,000, so 8,500. All right, so we've got the cash sales out of the way. And then we need the credit sales. So we need the month of October, we need the month following, and then we need 2 months following. So we need to start with August with that. And August is going to be 90,000, but then 10% of those sales are cash, so that 90% is going to be 81,000 in credit sales for August, and we're not looking at the in the month of August, so we don't have to do any discount on that one. And it says 25% are collected 2 months following the sale, so 0.25 would be 20,250, and we're done with August. So then we go to September, and we've got 110,000 in sales. 90% are credit, which is 99,000. And now we've got 40% of that are collected in the month following sale. So that's going to be 39,600. And then 25%, 24,750 will be collected in November, and we're done with September sales. All right, October comes along. We've already taken care of the cash part, so we've got 120,000, of which 90% will be on credit. All right, so 30% of that will be collected in the month of sale. So we're going to account for 32,400 in that month, but 90% gets a 2% discount. So I'm going to store this. And so 0.9, 0.02, So overall it's a 1.8% discount of that. One minus that will be 0.982, and I'm going to store that factor for future use. We will collect 0.982 of the October because the rest gets the discount. And so we're going to collect 31,081. I'm going to round that up to 7. It's 6.8. We're going to round that up to 7 on that. Okay, so we've got the 99,000. No, 108,000 times 40% is 43,200, and 25% is 27,000. So that takes care of October. Then we go to November. We've already dealt with the cash. We won't collect any of that. November, so we've got 95,000 in sales. 0.9 is 85,850, and then we need 30%, so 25,650, but we give a discount on that, and so that will be 25,188. Again, I'm rounding that. It's 88.3 on that, and then we go back to our 95,000, 85,500, and 0.4. And that will be 34,200. And then in December, we won't collect any of that in October or November. But we've got 85,000 in sales. In sales, and then 90% of that will be credit, so 76,500. Of that, we collect 30%, and then we give the discount. And so we will end up collecting 22,537 on that. Okay, so we just add those up, and we're done. 8,500. $92,237. Okay. For November, $102,638, and for October, $103,667. All right. So, so that's the first one. Okay. Number two, we've got Falcon Company anticipates the following costs in the upcoming year. Direct materials, $4 per unit. Direct labor, $12.50 a unit. Variable manufacturing overhead, $8 per unit. Sales commissions are anticipated to be paid at $2 per unit sold. Other costs are factory rent at $5,000 a month, supervisor salary at $4,500 a month. Personal property taxes estimated to be $3,800 for the year. The product sells for $40 per unit. Prepare a flexible budget for Falcon at 10, 15, and 19,000 unit level to include revenue and projected income. You may ignore taxes. This is the beginning month, so there is no results to compare to actual. Okay, so again, this is a flexible budget in advance at the 10,000, the 15,000, and the 19,000 unit level. Our sales are going to be let's see, product sells for $40 per unit, so that'll be 400,000, 600,000, and 760,000. Then we take our variable costs. Okay, so we've got $4 plus $12.50 is $16.50 plus variable manufacturing overhead of $8 will bring it to $24.50 plus $2 per unit sold commission. So $26.50. So that'll be 265,000. That'll be 397,500. And that'll be 503. $500. Okay, so that gives us our contribution margin. So that'll be 135,000. Okay. Then we get our fixed costs. Our fixed costs are 5,000 off. Now, remember, you have one in here per year, right? So we need to break that down. 3,800 divided by 12 is 316.67. Plus 5,000 plus 4,500 is 9,816. I'm just going to round that to 67. You could round it to 817. That would be fine with me. And then the fixed costs are fixed. Okay, so that's that one, a flexible budget. Um, the next one up, we have Falcon Company purchases parts from widgets from a wholesaler. They pay 80% of their purchases in a month. Should be a month that was a sale, month of purchase, and 20% following sale. They always take a 1% discount offered by the wholesaler. What are the expected cash disbursements for parts in October, November, and December? So we got October, November, and December. We only got 1 month lag, so we need September, October, November, and December on that. So with this one, since they always take the 1% discount, September will be 43,000 times 0.99, and they 0.2 will be 8,000. 514, and that takes care of September. In October, they have 55,000 times 0.99, and they pay 80% of that, would be 43,560. And 10,890. In November, they won't pay any of those up front, but they buy 43,000 in parts. They'll pay 42,570. And so that'll be 34,056. And 8,514. In December, we only worry about the 32,000. And 80% is 25,344. And just add those up. $33,858. All right, and so that's our cash disbursements for purchases. Okay. So now we've got this one's a little more complicated. We've got an inventory policy of 600 units plus 15% of next month's sales. So what is Falcon Company's production budget for October through December? So we have October, November, December, and January. 15,000, 17,000, 19,000 in November, and 24,000. Okay, so that's our sales. Then we need our ending inventory. So 19,000, 15%, 2,850 plus 600 is 3,450. 17,000, 15% is 2,550 plus 600 is 3,150, and December is 15,000 is 2,250 plus 600 is 2,850. Again, you don't have to do this part if you don't want. 19,850, 22,150, 27,450. Then we take off that we subtract the beginning inventory. Okay, so we just bring this down. It's 34,50 and 31,50. And then we need to calculate this one is 24,000 times 15%. 3,600 plus 600 is 4,200. And we just subtract those off. So we get 23,250 there. 18,700 there. And 16,700 there. So that's our production budget. Okay. Falcon Company is expected to have a beginning cash balance for July of $23,000. They're expected to have the following cash collections and disbursements. Additionally, they have an outstanding loan July 1st of $70,000. The interest is 0.75% per month, 0.75, so 0.75% a month, right, or 9% a year. On the loan balance at the beginning of the month, which they pay that every month, their banker requires that they maintain a minimum balance of $20,000. They make loan payments at the end of the month whenever the balance would exceed $30,000. They would also like to purchase a new widget machine at the end of August for $60,000. The banker has pre-approved them for that loan. Create a cash budget for the months of July, August, and September. All right, so we start with our beginning balance. And so that we were told they had 23,000 at the beginning of July. Then we have our cash collections. And that's just given to us at 120,000. Gives us cash available. $143,000. We subtract our disbursements of 108. That gives us a tentative balance of 35,000. They're going to have interest payment. $70,000. 0.00 75 is 525,000. And then we make a loan payment of 14,475, giving us an ending balance of 20,000. So now we have a 20,000 Yeah, there's a little ambiguity here. I don't know if they'd only go down to the 30,000. Let's assume they only go down to the 30,000, and so that would be 30,000. Okay, so then our collections in August would be 140,000, giving us cash available of 170,000 minus disbursements of 132, leading us to a tentative balance of 38,000. Interest payment be 70,000 minus 4,475, be 65. 25 times 0.0075 is 491.43. So let's just say 491 for the interest payment. The loan payment will be 7,000. $508, leaving us with 30,000. But now we've got our capital expenditure. So we've got a loan of 60,000 and an expenditure of 60,000. Gives us 30,000. Okay. September, we go to 30,000. Our collections are 150, 180,000. Disbursements are 105. Leaving us with 75,000 tentative balance. Okay, so we had 70,000 balance minus 4,475 minus 7,508 plus 60 times 0.0075. So our interest payment is going to be 885. Oops, and then we've got the loan payment. Of 44,115, leaving us with a balance of 30,000. Okay. And then the last one of this group, Falcon has the following production schedule. July 40,000, August 50,000, September 60,000, October 40,000. It takes 20 panhead screws to assemble a widget. The company anticipates having 8,000 panhead screws in stock at the beginning of July. Their policy is to have 5% of the number of screws needed next month in ending inventory. How many panhead screws will Falcon need to buy in July, August, and September? Okay, so July, August, September, and October. So I'm just copying what's given there, 40,000, 50,000, 60,000, and 40,000. That's the units. Now we need to convert that to parts, or in this case, screws. And so that's 20. So that'll be 800,000. 1 million. 1,200,000. 800,000. Okay, so that's how many screws we need just for the production. We then need to create our ending inventory. Is 5% of the number of screws needed next month. And so that should be 40,000. Whoops, needed next month should be 50,000, right? 1 million. Yeah, 50,000. 1,200,000. Would be 60,000. And 800,000. There's our 40,000. Again, this intermediate step you don't have to do. And then we have to subtract off the beginning inventory. This time we're starting at the month where they're telling us how many they have. They only have 8,000 panhead screws in stock. So they're not following their thing here. So then we've got 50,000 here and 60,000 here. Okay, so 842,000 they need to buy in July. 1,010,000 in August. 1,180,000 in September. All right, that takes care of that group. Okay, let's look at the last group. It says at the top that it's quiz 4, but this is actually a compilation of several exams, because different textbooks, the order of chapters are somewhat different, and so what gets included in a particular test, you'd have a lot of stuff that wasn't covered if I just gave the test, so I edited it. All right, so here the first step in budgets is the preparation of the sales forecast. That's always where we start. Okay. And number 2, M&N Company has 2 products, M and N, with an inventory beginning of 195 yards of N and 345 yards of N. Sales for the coming period is anticipated to amount to 2,900 yards of M and 3,600 yards of N. The company's policy is to keep at least 15% of the period's sales in inventory. Budgeted production of N amounts to. Okay, so we always start with the sales, right? $337.60, and they want 15% of the period sales. So we're actually looking at this period, right? So this is our sales. Then we want the ending inventory. So this one's a little different since we're looking at the current month sales. So 3760 enter 15% is 564. And then we subtract off the beginning inventory for 300 and 300. Said it right, wrote it wrong. And 45 yards. And so we just add that up. So we need budgeted production of 3,979 yards. All right, number 3. Bestwich Company has budgeted production for the first year as follows. These are quarters. 2 pounds of material A are required for each unit produced. The company has a policy of maintaining a stock of material in A at the end of each quarter equal to 25% of next quarter's production needs for material. A total of 30,000 pounds of material is to start to begin hand budgeted purchase material A for the second quarter would be. Okay, so we'll have the 80,000 times 2 pounds of material is 160,000 pounds. That's what we need for just the production. Then we need the inventory. 190 times 2, or sorry, 90 times 2 would be 180, times 25% would be 45,000. That's our ending inventory. And then 25% of 160 would be 40,000. So their purchases would be 165,000. Again, because we're looking at the second quarter, this 30,000 pounds of material in the first quarter is meaningless to us, right? So they're just throwing you information you don't need. Okay, number 4. Salich Manufacturing Corporation has provided the following sales budget. Cash sales are normally 40% of sales, and credit are expected to be collected in the month following the month of sale. The amount of cash expected to be collected from customers in September is, all right, so September will be 40% of 60 is 24,000 plus 60% of 55,000 is 33,000. So we've got 57,000 is expected. Notice that there's no discounts here. There's no extended months. So that's the total for that one. All right, number 3. Information pertaining to Yex Company budgeted sales revenue for the first quarter of the year is below. Management estimated 4% of credit sales would be uncollectible. Of the credit sales, 60% would be collected in the month of sale and the remainder the following month of sale. Calculate the total budgeted collections for February. Okay, so we're going to have cash of 160,000. That's our February cash sale. And then we'll have so notice this one, of the collectible credit sales. So they're throwing you a little bit of a curve here. 60% will be collected in the month of sale. So our February credit sales is 440,000, but we're only going to collect 96% of that. So that 440,000, 422,400, and in the month of sale would be 60%. So that's what's collectible. And then 60% of that would be 253,440. That's Feb credit. And then we go back a month to January credit. So that would be 330,000. Again, we're only going to collect 96% of that. So 316,800. And the remainder of that would be 0.4, would be 126,720. Oh. Yeah, let me check that to make sure. $541.60. Okay, so that's that one. Number 4, Lightning Inc.'s sales budget showed the following projections for the coming year. Inventory on December 31st is expected to be 20,000 units. The quantity of finished goods each quarter was be equal to 7% of next quarter's budget units to be sold. Calculate the units to be produced in the third quarter. So once again, that 20,000 is meaningless to us, right? We need the third quarter. So we've got 140,000 plus 7% of the fourth quarter, which is 160,000, is 11,200. But then we subtract 7% of the 140,000. 9,800. And so we just add that up. So we need the units to produce in the third quarter will be 141,400. Okay. Now the master budget usually begins with the sales budget, sales forecast. So I'll give you that one. Part E company plans to sell 12,000 units during the month of August. If the company has 2,500 units at the start of the month and plans to have 2,000 units on hand at the end of the month, how many units must be produced? So the change is going to be, they're going to go down in inventory by 500, so they need to produce 500 less than the sales, so that would be 11,500 or A. Number 10, the PDQ company makes collections on credit sales according to the following schedule. 25% the month of sale, 70% the month following sale, 4% the second month following sale, and 1% is uncollectible. The following credit sales have been budgeted, and so we're looking for June sales. So June is 110 times 25%. Is 27,300. 500 out of the June sales will be collected. May, we will collect 70%, so that's 120,000 is 84,000 in May, and then April will be 100,000 is 4,000. Add that up. $115,500. Answer D. Okay. Number 16. Edwards Company has projected sales and production in units for the second quarter of the year as follows. Sales production required cash production costs are budgeted at $6 per unit produced. Of these production costs, 40% are paid in the month which they're incurred, and the balance the following month. Selling administrative expenses, all cash, amount to $60,000 per month. The accounts payable balance on March 31st totals $96,000, all of which will be paid in April. Prepare a schedule for each month showing budgeted cash disbursements for Edwards. All right. So let me grab a piece of scratch paper here. So we're just wanting cash disbursements. We won't worry about the sales at this point. We might on the next one. So our cash disbursements, we've got accounts payable, 96,000. Production was 25,000 times $6 per unit produced. So that would be 150,000. And we paid 40%. Is 60,000. All right. So this is April. Okay. So then we've got selling administrative expenses amount to 60,000 per month. So we've got 120,000 plus 96,000, 216,000. In May, our accounts receivable, we had 60,000. So this is going to come out of May is 90,000. And then our production is 25,000, so that'll be 60,000 again and 60,000 again. And that's going to come up to 210,000. And then June, since our production was the same, the accounts payable will be the same, 90,000. And our production there is 30,000. Oops. And we pay 40% of that is 72,000. and then 60,000 in fixed costs. All right. 162, 222. That, okay. So that takes care of part A, 16A. And then it asks us to assume that all units will be sold on account at $15 each. Cash collections from sales are budgeted 60% the month of sale, 30% the month following sale, and the remaining 10% in the second month following sale. Accounts receivable on March 31 totaled $225,000, 45 from February sales, and the remainder from March. Prepare a schedule for each month showing the budgeted cash receipts for Edwards Company. Okay, April, May, June. Okay, so 60% in the month of sale, so 30,000. So remember that was in units. So 30,000 would be 450,000, and 60% of that okay, so I'm starting with April here in the middle. So we get 450,000 in sales times 60% of that will be 270,000. 3% the next month, so that will be half of that, so 135,000, and 10% will be 45,000. Then May, we won't collect any of that in April. Our budget of sales are 20,000. $15 a piece is 300,000. 60% will be 180,000. 30% will be 90,000, and the other 30,000 will be collected in some later month, July. Okay, then June, zip and zip, 25,000 units sold, 375,000. 60% will be 225,000. Okay, so that takes care of the current sales. Now we have to go back to the accounts receivable. Accounts receivable were 255,000, 45 from February's sales. So all of that will be collected there. That leaves us with 220,000. No, sorry, 210,000. And that will be 40%, or a quarter will be collected in March. Oops. $52,000. No, that's not right. $210. That part's right. What is that? $157,000. There we go. And that one will be 52,500. And now we just add those up. And that is our cash collections on B. Okay. Number 19, Modesto Company produces and sells product Alpha B. To guard against stockouts, the company requires 20% of next month's sales be on hand at the end of each month. Budgeted sales of product B, Alpha B, over the next 4 months are. In addition, the company expects to have 5,000 units of Alpha B on hand of May 31st. Prepare a production budget for June, July, and August. So we've got June, July, August, and September. 30, 40, 60, and 50. Okay, so that's our sales. Then we need the ending inventory. 20% of next month's sales, that would be 8,000. That would be 12,000. And that would be 10,000. Then we just bring that down, 12,000. Bring that down, 8,000. And we are told to have 5,000 units on hand. All right, so this will be 33,000. This will be 44,000. And this will be 58,000. That one. Bonus question. To make 1 unit of product Alpha B, it takes 7 pounds of solvent. On May 31st, the company has 42,000 pounds of solvent on hand. They desire to keep 30% of next month's requirement. How much solvent will be required to be purchased in June and July? So let's go back here. I'll do it up above there. So June, July, August, our production is 33,000, 44,000, and 58,000. Okay, we need to convert that to pounds of 7 pounds of solvent. So we need 7 times 7 times 7. $231,000 pounds. 308,000 pounds. 406. Okay, so that's how many pounds they need for production. They want 30% of next month's requirements and ending inventory. So 308. So their desired ending inventory is 92,400 and 406 is 121,800. Okay. May 31st, they have 42,000 pounds on hand, so that's 42,000 goes there. This one we bring the 92,400 down there and just subtract that out. So they need to buy 337,400 pounds in July. And 281,400 in June. Okay. Which of the following is not a shortcoming of participating budgeting? So A is the one that's not a shortcoming. The others are all shortcomings. All right. That's an advantage. Number 7, a comprehensive or overall, a comprehensive or overall formal plan for a business that includes specific plans for expected sales, units to be produced, the merchandise and materials to be purchased, manufacturing, selling, administrative, general expense to be incurred, long-term assets to be purchased, and the amounts of cash to be borrowed or loans to be repaid, as well as budget, income statement, and balance sheet is called a master budget. There we go. Which of the following budgets must be prepared before preparing a cash budget? Capital expenditures budget, yes. Sales budget, yes. Manufacturing budget, yes. General administrative, yes. So E is the correct answer, all of the above. On that, number 18, Zepost Company has developed the following sales budgets for 6 months of the coming year. The beginning inventory on January 1st is 8,000 units. Desired ending inventory for the coming year is to be 25% of next month's sales. Each unit requires materials at $8 per unit and 3 units materials for Y at $2 per unit. All right. So prepare a production budget in February, March, and April. Okay. So again, that the beginning inventory January 1st is meaningless here. And for both the materials there, right? So we want February, March, and April. So we've got our sales, 30,000, 50,000, and 70,000. Then we need the ending inventory. Ending inventory is 25% of next month's sales, so that's 12,500 there, 17,500 there. I guess we need May. Actually, we're going to need June. We're going to do the materials for that. Okay, so 25% of that is 15,000, and 25% of that is 12,500. Then we need to subtract off the beginning inventory. So we just bring these down. Like so. Then we need to figure the beginning inventory here would be 25% of next month's sales. So that would be 7,500. That's right. Okay, so that'll be 35,000, 55,000, 67,500, and 57,500. Okay. Very good. So that's part one. Part two says we need the purchases budget. So let's do Y first. No, let's do X first. Okay. So each unit requires 6 units of X. So X is going to be times 6. $210,000. I'll give you a second to catch up there. Sorry about not moving that down, but we've done enough of those. You know how to do it. You can see what I did. 55,000 times 6 is 330,000. 67,500 is 405, and 57,500 is 345,000. Okay, so that's how many pounds we need for production. Then we need the ending inventory, which we're told is 30%. So 30% of 330,000 will be 99,000. 30% of 405,000 is 121,500, and 30% of 345,000 is 103,500. Now we need to subtract off the beginning inventory. Remember, this is our production needs. Right here, this is the ending inventory. And then we need the beginning inventory, so let's just shift those down. And then calculate that. The production needs were 210,000 times 30% is 63,000. Okay. So we'll need to buy, this will be our purchase in pounds or units. Right. Purchasing units. And then we simply multiply that times 8. $3,096,000 in April. $2,820,000 in March. $1,968,000 in February. Okay, so that's just for material X. Then we have to do the material Y. So I'm going to copy this, what we have here. It's 35,000, 55,000, 67,500, and 57,500. And now we go back up here. We need 3 units of Y. So we multiply this times 3, each of these times 3. All right, so that's how many units of Y we will need for production. All right, again, it's a 30%. So this is production needs. Then we need the ending inventory, which is 30% again. $49,500. $60,750. And $51,750. And then we need to subtract the beginning inventory. So we'll just bring these down. And then we've got to calculate this one, right? So 30% of 105 will be 35,000. So this will be our purchases of Y in units. And then we need the price. The price was $2 a unit. And so that is our price. That's our purchases in dollars. Okay. All right. Take care of that one. Okay. Perfecto Company is in the process of preparing its cash budget for the year. The sales forecast the last 6 months. Historically, analysis of payment patterns of their customers has provided the following: 50% month of sale, 35%, and 50% of the payments made in the month of sale receive a 2% discount. So you can just figure a 1% discount is what they'll receive of all the payments, right? And so it asks us to prepare a cash collections schedule for October, November, and December. All right. October, November, and December. So we've got, so we'll go back October, so we'll go back to August, September, October, November, and December. So in August, we had 80,000. And we collect 10% of that. So that's going to be 8,000. Then in September, we had 90,000. And we'll collect 35% of that in September. And 9,000 in November. Nothing in December. Then in October, we had 120,000, or anticipating 120,000. We will collect 50%. Is 60,000. but we'll only collect 99% of that, right? Half the payments receive a 2% discount. And so that'll be 59,400. Go back to the 120,000. 35% the month after sale will be 42,000, and then 10% will be 12,000. November, we got 150,000 times 50%, 75,000 times 0.99 will be 74,250. And 52,500. And then December, 200,000 times 50%. Times 0.99 is 99,000. And just add those up. $163,500 in December. $125,250 in November. $98,900 in October. All right, so that's that one. And then next one, Lightning Ink sales budget inventory, December 31st, the current year is expected to be 20,000 units. So we want the units to be produced in the third quarter. Once again, that 20,000 is meaningless. Our sales is 140,000 in the third quarter. 7% of next month's budgeted sales, 160.07 is 11,200 for the ending inventory. And then we need to subtract off the beginning inventory, which will be 7% of 140,000 is 9,800. So we need to produce 141,400. And that concludes that. Okay, so we've got a budget. We've done several of the flexible budget. We did several of the standard costing variances. The thing we're missing is some activity-based costing, so I'll try to get that out between now and Saturday sometime. So good luck on your studies, and I'll make one more, do 3 or 4 activity-based costing problems.